Welcome everybody to Elephants on Business podcast, improving our small business journey together, one episode at a time. Today I've got Sam with me. Obviously Shay's away today, and we're going to be talking about financial statements and what that means for business owners. Welcome, Sam.
G'day. It's good to be back on.
Yeah. What's this? Your second one?
Third, I think. So
yeah,
it's been a bit of a couple of months off, but yeah, it's good to be back.
Yeah, it's great to have you back. So today we're talking about financial statements. So typically as accountants, that's what we prepare, and that's basically our bread and butter, and we always look at them, and obviously when it's your profession, you know, you understand them back to front, and there's probably a lot of assumed knowledge at times. And typically what we see is there is a lot of business owners that don't really look at their financial statements, and you know, they don't really monitor how they're going. And we're just going to deep dive into, you know, some of the things that you can do and why you should be monitoring your financial statements. But the first question is obviously, you know, why do you think people aren't looking at their financial statements at times?
I think it's generally they're done after the fact. So not a lot of people, like, you've probably got 11 months to get them done. So the due date's usually May the year after. So everyone varies, you know. If people are going for borrowing, they might get it done July. Other people get it done after Christmas, October. So it varies. So say if you're getting it done December or Jan like now, it's 6 months after the fact. So the business could have moved in that time frame. So it's
there could have been a lot of changes since closing off the financial year, right?
Yeah. So to most business owners, it doesn't give them a picture of what is currently happening. So it's 6 months ago, or, you know, it could, I suppose that picture is even 18 months ago because it's from July to June, that you're looking back on historical information. So that's why I think one point that, you know, business owners just
ignore it.
Yeah, just go, well, it's done. You know, what's the obligation? Let's move on.
Yeah, especially like if we're doing, you know, let's say 2022 financial statements, and as you said, you've got till 23 May to complete it. And if it's generally a payable situation, most business owners would like to, you know, kick that out sometimes. And then when they receive their financial statements, as you said, they're probably like, well, what's the point? It's running from 1st of July 21. You know, we're in 23, so it's you know, almost 18 months away, as you said.
I think most of our clients at Elephant, what they really like is the tax planning we do in May. So it's in advance because they get to see the outcome, can project what it looks like. So when we go to do the financial statements, they already know the outcome. So it's it's ticked off, just ticking the boxes in that.
In the compliance.
Yeah.
So like we generally like to do a tax planning session. So we generally hold that in April, May, and that's looking at the current financial year's 9 to 10 months performance, and we generally just estimate till June. And then the clients sit down with us, go through the numbers. And I think there's a lot of, you know, feedback, and clients do actually enjoy that sitting and going through the financial statements because it is quite current at that point in time. But if you're just looking at it, you know, at the end of a financial year and you're just doing it because of compliance and you want to do your tax return, I think sometimes, as you said, those financial statements aren't quite useful.
I suppose,
and I think it comes back down to maybe in the past there wasn't those tools around, right? So like we've got Xero, which links into your bank feeds now, and you've got the real life data. And essentially, if you're keeping that file up to date, you can run reports quite instantly and get the feedback from that business, right?
I think, say, just a basic example would be, you know, you've got a business that goes, well, I want to increase my revenue by, say, 200,000, and they come to yours and then they go, we increase revenue by 200. We hire staff members, say 70 grand. There's an outlay of overheads in, you know, whatever industry that they might be, materials or, you know, getting a computer or whatever it is, whatever industry. What's the profit look like on that? And then obviously there might be expenses on bringing in that 200 grand revenue in. So it's like, what's the profit look like? How much work is to bring that 200 in? That could be done in that tax planning. That's what they generally ask us. How does that look? What's my profit look like? Is that achievable?
Yeah.
But on the other side, if they're doing the financials in December, they've already increased that by 200,000.
Yeah.
It's done.
Yeah.
They know the outcome, so it's like, well, I've done that.
Yeah, they've made that decision already, and it's
Mm.
moved, and they probably don't really see what's happened to the numbers. So I guess we'll run through a couple of points that we've got here, just for sort of the listeners out there to keep in mind. Obviously, going into the new financial year 23, a lot of people probably sit back in December, Jan, come up with goals, you know, and it is a nice time to also reflect on your financial statements and make sure you have that access to monitor them, and you know you are on a particular software that can give you that information quite quickly. The first one on our list, so generally there's obviously financial statements, that being a profit and loss and a balance sheet. Those are the ones that we typically use, and at times we obviously rely on cash flow or a cash flow statement. But the first one on the list is revenue and expenses. So this one's generally off the P&L, right? So what should a customer or a client be looking at, or a business owner be looking at in, say, a profit and loss? Or
profit and loss is important. I suppose it's sometimes is that you look at the bottom line, what the profit is important, but then obviously from the top part is the revenue, the turnover. That gives you a gauge of what you're turning over, what money is coming into the business.
Yeah.
And obviously you want to be running at a profit at the bottom, and then the percentage of expenses per revenue. So each industry is different, but you probably got your key expenses for each industry. So like construction might be materials, so you want to know you're in the range in your industry of materials to turnover.
Yeah, so just break that down. So like essentially it's, we've got a certain revenue that we're achieving, and then, based on your industry, as you said, there's potentially a benchmark.
Yeah.
And let's say, for example, that's 50% like should be spent on materials in that, in an example. So if we've got $100,000 of income, typically if you have a benchmark of 50% spent on materials, we should have, 50,000 on materials as an expense line item, right?
Yeah.
So what that allows you to do is have that mechanism to check, are you overspending on materials, or are you, not selling enough, right? So like, are you underselling yourself?
Because there's a good example now, the construction industry, materials going through the roof. So obviously construction owners would know that, but it's still, if it has gone up, are they still getting that same ratio? Is that ratio right now that it's gone through the roof?
Yeah.
Is it being on charge to clients?
So, in that example, it's like we may need to adjust sales to compensate for the increase in materials to align that ratio back up.
Correct.
And have it back in line with what, our industry benchmark should sort of represent. So, obviously going into the next year, it is nice to look at, at least your percentages, your GP margins.
The other main ones are usually like your wages cost or contractors.
Yep.
Some industry, they're like, is it better to do contractor or wages? Then you can look at it and go, well, this is how the percentages look if we go down the contractor path or if we go down the wage path. Especially getting that one right as well, because that usually is everyone's main cost. So
yeah, it's a big expense for many small businesses. So getting that ratio right.
Are you overstaffed?
Yeah.
Understaffed? And not, because you don't want to be understaffed, burn the staff out, lose key staff members. Are you overstaffed? Not getting enough out of profits not there.
Yeah. So like if you overstaff, obviously the expense percentage as a against the revenue is going to be quite high, which means, it's not necessarily a bad thing if you're going for the next phase in your business and you know that potentially, yes, maybe for 6 to 12 months, that percentage may look high because we've got extra capacity and we're going to build up to the next sort of level of our business. But obviously if you don't have those plans and you're just trying to run your business and that percentage is high, then potentially you're overstaffed, and then that could be a huge issue. And that means whatever's coming into the business is not directly going into the bottom line, then affects your pay, and then it stresses people out, and you, as an owner, that's the last thing you want to happen, right? So that's probably a good little tip, just to look at percentages, understand your industry, what are the benchmarks look like for your particular industry, and then and then at least if you know the benchmarks, you can cross-check it against your P&L and then work out where you sort of sit, and then always take it with like a grain of salt, because it does depend on the strategy. If you're going for that growth phase, certain percentages may be out of whack, but if you're in sort of a holding, fix up stage where you want to, get the best out of every expense that you're, deriving, you probably just want to cross-check that against your industry. So the next one on the list is, cash flow. So cash flow is quite important. Like, it's the lifeline of a business, right? So typically that's done through like a cash flow statement within Xero, or a cash flow summary. There is some clients that might do it as a spreadsheet. What are some of the things that, I guess a small business needs to look out for in there?
Yeah, so in that one is obviously it's probably an extension of your profit and loss, really. But what it takes into account, sometimes people have debtor issues. So like, obviously it's all good getting the sale, but like if the money's not coming in and you've got, creditors owing contractors, materials, so your money is actually going out and you haven't received the money. So it's just important to make sure that there's always a buff. You have your buffers there, always enough money there, because that's why most small business probably fail, is just they just cash flow problems. So
that's a great point that you just mentioned there. So essentially, if you're looking at your profit and loss in one metric and it's on a accruals basis, right? So like, you've probably issued an invoice to a particular customer. If you haven't been paid, the profit and loss may look great, but then when we look at the cash flow statement, it may look quite poor because you haven't collected yet. So it's probably important to make sure you're monitoring, how much cash collection is coming in, what are future obligations that may come out. So, there's obviously like GST that you need to pay as you go withholding, and maybe you need to pay some suppliers. So it's always nice to, keep a track of that. And there is software out there that can be added on to Xero to give you an idea. Xero's got its own sort of platform within it where you can do a little bit of a cash flow projection and input certain things that you are going to pay, and essentially will give you like a fluctuation in the balance. Basically, you just don't want it to go into negative, and that's probably the worst situation, as Sam said. It's probably why most businesses fail. They're not really collecting on time, and they've probably overcommitted to certain obligations, and they're just really just trying to juggle the two. And then, it can take one little instance where you're not paid on time and you're not paying your obligations, and it can all fall apart. So it is important to maybe project out some cash flow and see where your balance is going as well. It's one that we do within our business anyway, so it does come quite important at times, right? So the next one on the list is your net income, or your profit within the business, right? So what are we typically seeing there, Sam, on that side?
Yeah, so that's probably what everyone owner wants to see, is what your profit is. It's what you kind of have made for the year, I suppose. Some people, business owners, probably just have no idea. Like, they're just like, it's going well. I've got no idea what I'm actually making, because sometimes you just want to see,
what that bottom line is.
What is it that? Then it's like, well, I suppose, what can I take home? What do I want to reinvest in the business? What I want to do with those funds? And then obviously where that tax plan we talked about earlier comes into, it's like, well, can we minimize our tax? Can we
invest in the business?
Can we reinvest in the business? What can I take out? A lot of people just don't know what they can do, what they can't do, what they should be doing.
I think this is a good metric to always look out for. It's generally when we speak about profit and loss, like a lot of the times, it's done on an annual basis. But if you've got the correct software and you can run the reports, you can look at your profit and loss on a monthly, on a quarterly basis, and compare against different quarters, maybe a half, like a 6 month project, like you look at it in a half yearly, 6 month view, and look back again, or look at it on an annual basis. So you can take a long term view at your profit and loss, or you can also look at a short term view of your profits. And as Sam said, like you do want to make decisions based on that. At times, if there's a profit, do you want to reinvest in your business and potentially drive that business to sort of that next level?
I suppose a lot of our clients as well, they like doing in the construction industry, like job by job. So then you can get a profit of per job, or time spent on that job, or so it's kind of like that net income, but it's per job basis or project.
Project basis.
Because then it gives you, I want to start targeting more of those jobs because it's more profitable. So it's really, if you delve into that, you can really work out what, is profitable for the business.
Yeah, which is an excellent point. Like, and you're not really going to get that metric if you're just looking at your financials once a year and you're just looking at the profit and loss in that 12-month journey and comparing it to last year. That's why it is important to always check back in. And as you said, if you are in a specific industry where you're running it on a project basis, you do probably want to check in and look at, okay, did that project go well? What type of project was that? What type of client was that? And can I just replicate that and just keep doing those type of projects versus, another service line that's probably not doing it as well. And if you're not tracking it on that regular basis, you'll probably never know which project, was performing better than another service line project, in a sense.
Critical.
And then the last one that second last one that we have on the list is, to do with the balance sheet, really. Just looking at your assets and liabilities. Generally the one to sort of look at is probably your liabilities in this section, right? So most of the time, obviously, your assets are, cash at bank, some inventory, and obviously some other equipment and things of that nature, and obviously your receivables. But, the one that we urge, our clients to look at is obviously your liabilities. What debts and obligations do you have? And, do you have enough cash or, potential cash coming into the business to make sure your obligations are getting paid, right?
So you definitely want to be in a position where your assets, or your net assets, so your assets less your liabilities, is positive. So that means you've got a worst case scenario, you could always pay off those liabilities.
If you were to,
if
if all your liabilities at one point in time said yes, pay me now, you have sufficient obviously assets to recall on that. Obviously, practically probably never happens where it's just at a given day all your liabilities are due, but it is a good sort of metric to know that you've got sufficient assets to cover off your liabilities. And when we mean liabilities, there's obviously a couple of types of liabilities there that you need to sort of monitor. So it's like your short-term, and then obviously your long-term liabilities. And then generally, your short-term liabilities are like your ATO debt and
pay as you go
withholding.
Any ATO obligations, income tax, but probably the biggest one, the pay as you go withholding and super just seems to get a lot of clients in our case. Like they just kind of go, well, pay your employees, and then you think, I've paid them, but that creeps up onto me every quarter or month, whatever it is. Just always seems to creep up on them, going, well, it's come around again. And
it goes past very quickly at times, and if you're not all over it, you can see how it can cripple your business where you haven't put aside enough. And that's why we promote obviously having a separate business account where you can sweep your savings and your super and your tax obligations into that account, and make sure you have them ready when it's time to pay.
The other ones, usually as well, they might have a car loan or a business loan or something like that, or accounts payable, really.
Yeah, beautiful. And then the last one there is just like, obviously, looking at the financial statements is, giving you information about your business and where it's tracking, but you also want to probably set goals, right? So what are some of some goals that small businesses can set and track along the way?
I suppose it's about like it's probably this summarizes all executing all of the above. So it's like from the top was like your revenue. What is it? You want to get to X amount of revenue, or is it you want to get to X amount of staff, or is it your
GP margin,
GP margin, or is it your net income? You want to get to X, like you've got to the turnover you want, but you want to go net income's the most important thing to me. I want to lean out the expenses and hit that profit, or is it
there's not enough revenue? I want to go increase the revenue. Increase
the revenue first, and then go for profit later. So, or I want to reinvest in the business. So, it's a lot of those ones, I think.
Yeah, so it is dependent on like your business journey and what you're trying to achieve. I guess that's the goals that you would generally aim for based on your business goals, right? So like as you said, if it was I want to increase revenue in the next 6 months, then it's nice to track obviously new sales, new leads, and how much of that is converting, and then obviously track your advertising spent on that and what if you are getting sales in, how much that's costing you as well. If you are in a position where you're happy with revenue and let's say you have enough capacity through wages, but you feel as though maybe you're still overspending in some areas, then you probably just want to track more of your percentage of expenses on revenue, and maybe is there things that you can cut out to lean out that business, and at least then you get things go straight to the bottom line and you're deriving a larger profit in the year.
I think some business owners, it's always good as well, like they like to have the short, medium and long term goals plans as well, because short term it might be we want to get the turnover up. Medium term goal could be let's cut out the expenses once we've got the turnover up and hit X amount profit, and then long term might be these are all financial figures. Sometimes they you can have just business goals as well, as like we want to be the best accounting firm in Melbourne or something, or we want to be known for doing
like a specific industry or something, or service that
we're the best cafe, or we're specific to serving this kind of food in this region or whatever it is. But also we're looking at the financial side here.
Yeah, and that will probably wrap it up, I guess. Like to sort of summarize it quickly, obviously, you do want to look at your financial statements. We tend to see clients that like they're sort of not even interested at all in it. Obviously, it comes with once again having the software in place that will give you the data immediately, and then the 5 points that we sort of discussed was having a look at your revenue expenses, which is basically a profit and loss. Reviewing your cash flow statement and what's actually coming into the bank account and what's going out, and obviously having projections and a scenario analysis behind that. Your net income, which is basically what's going down to the bottom line of your P&L and what that profit is, and how to adjust that as time goes on. And then your balance sheet, which is your assets and liabilities. In particular, make sure you're across all your liabilities and what's short and long-term liabilities. And then the last one there was just setting the goals and making sure you're tracking those goals, whether it's financial or business oriented. And that's pretty much it for today, right?
Yeah.
So thanks a lot.
And
cheers. Have a great day. Bye.